You've been paying your credit card bill every single month. On time. No missed payments. And yet, somehow the balance barely moves. If that sounds familiar, you are not imagining it. And you are not alone. Right now, Americans are sitting on $1.25 trillion in credit card debt. An all-time record. And more people are falling behind on payments than at any point in the last 15 years. So today we're going to break down exactly why your credit card balance refuses to shrink, what's actually happening behind the scenes with interest rates and delinquencies in 2026, who's getting hit the hardest, and what you can actually do about it. Let's get into it. The paradox. Here's the thing that confuses most people. You didn't buy a car. You didn't take a vacation. You just lived. Groceries, gas, a doctor's visit, maybe a car repair you didn't plan for. You put it on the card because that's what the card is for. Then the bill comes. You pay more than the minimum because you're responsible with money. And still, next month, the number is almost exactly where it was. This isn't a personal failure. It's math. It's structural. And in 2026, that math has gotten worse for almost everyone carrying a balance. To understand why, we need to look at three things: how much debt Americans are actually carrying, what interest rates are doing to that debt, and how many people are starting to fall behind entirely. How big is the debt? Really? Let's start with the scale of this. Total U.S. credit card debt hit a record high near the end of 2025, before easing slightly in the first quarter of 2026, which is normal, because people usually pay down some of their holiday spending in January and February. Even with that seasonal dip, total balances are still sitting around $1.25 trillion. To put that in perspective, that's up more than 60% since the pandemic-era low in early 2021, when Americans were flush with stimulus money and paying down cards aggressively. That era is long gone. On a per-person basis, the average credit card balance is somewhere between $6,500 and $6,700, depending on which source you look at. But that average hides something important. If you only look at households that actually carry a balance month to month, meaning they don't pay it off in full, the real average jumps to somewhere north of $10,000. That gap matters. Roughly half of credit card holders in America pay their balance off every single month and never pay a cent of interest. The other half, the half we're really talking about today, is carrying debt forward month after month, and that's where this story gets painful. And here's the part that should really catch your attention. Americans paid out roughly $250 billion in credit card interest and fees in a single year. Triple what it was just a few years earlier. That's not new spending. That's not new stuff bought. That's $250 billion that just evaporated into interest charges. The real reason balances don't shrink. The rate trap. Okay, so now let's answer the actual question in the title. Why doesn't the balance go down? 2 words. Interest rates. The average credit card interest rate in 2026 is sitting around 21% across all accounts. And if you're one of the people actually carrying a balance, it's closer to 21.5%. For anyone opening a new card right now, average offers are creeping toward 24%. Let's make that real with numbers. Say you're carrying the average balance for someone who revolves debt. Call it around $6,500. At 21% APR, that balance alone generates over $1,300 in interest a year. That's roughly $110 a month in pure interest before a single dollar goes toward what you actually owe. Now here's where it gets brutal. Most credit card companies set your minimum payment at 2% of your balance, or $25, whichever is higher. If you're only paying that minimum, look at what happens. On an average balance, making only minimum payments, you could be looking at over $10,000 in interest paid over time, and it could take close to 17 years to actually pay it off. 17 years. On a balance that started under $7,000. This is why your balance isn't shrinking. It's not that you're bad with money. It's that the minimum payment was never designed to pay off your debt. It was designed to keep the account open and the interest flowing. Minimum payments are functionally a debt perpetuation tool, not a debt payoff plan. And zoom out for a second, at current rates, on the $1 trillion+ of credit card debt Americans are carrying, the math works out to somewhere around $260 billion a year in interest system-wide. That's the machine we're all plugged into. Now let's talk about what happens when people can't even make the minimum. This is where 2026 gets genuinely alarming. According to the New York Federal Reserve, the share of credit card balances that are seriously delinquent, meaning 90 or more days past due, has climbed to its highest level in about 15 years. We're talking levels not seen since the aftermath of the 2008 financial crisis. Now, I want to be careful here because you'll see different delinquency numbers depending on the source, and it's important to know the difference. The Federal Reserve Board's broader measure, covering all commercial banks, puts the delinquency rate closer to 3%. That number has actually been trending down for 7 straight quarters. Meanwhile, the New York Fed's measure of severely overdue balances tells a much darker story, with double-digit percentages of balances going unpaid for 3 months or more. Both things are true at once. The average American with a credit card is doing okay. But a growing subset of Americans are falling into serious, prolonged financial distress. And that gap between the average and the struggling is widening every quarter. One especially telling detail: delinquency rates at smaller community banks are now running roughly double the rate at large national banks. That tells you something about who's under the most pressure, often lower-income borrowers and smaller regional lenders who serve them, versus the big banks with stricter underwriting standards. And maybe the most sobering statistic in all of this: only about 1 in 7 delinquent borrowers is actually enrolled in a hardship program through their card issuer. These programs exist: reduced interest payment plans, temporary relief, but millions of people either don't know they exist or run into barriers trying to access them. Who's getting hit the hardest? Debt doesn't hit everyone equally. Let's break down who's really carrying this weight in 2026. By generation, Gen X, people roughly in their mid-40s to late 50s, carries the heaviest individual credit card burden, with average balances pushing close to $10,000. That's the sandwich generation effect. Many are supporting aging parents and kids in college at the same time, all while their own careers are past peak earning growth. But here's the trend that should worry you more. Gen Z, the youngest adults just entering the workforce, has the fastest growing credit card debt of any generation. Their average balance has already climbed past what the oldest living generation carries. These are people in their first few years of adult financial life, already normalizing revolving debt before they've built any real savings cushion. By income, this is where it gets interesting. In raw dollar terms, higher-income households often carry the largest balances because they have bigger credit lines and bigger spending. But relative to their income, it's lower and middle-income households carrying the heaviest burden, and they're the ones showing up disproportionately in the delinquency numbers. Geographically, it varies a lot state to state. Some states have actually seen credit card balances shrink over the past year. Modest good news in places like New Mexico, West Virginia, and Louisiana. But that's the exception, not the rule nationally. And running underneath almost all of this is inflation. Prices are still climbing faster than the Fed wants, driven heavily by energy and shelter costs, while wage growth for a lot of households hasn't kept pace. When your paycheck buys less than it used to, and an emergency expense hits, the credit card becomes the shock absorber. Multiply that across millions of households, and you get the debt picture we're looking at today. The minimum payment math. Why it feels like quicksand. Let's slow down and really sit with the math here, because I think this is the single most important thing in this whole video. Imagine 2 people. Both owe $6,500. Both have a 21% interest rate. Person 1 pays only the minimum every month. As we said, that's roughly 17 years to pay it off and over $10,000 in interest. More in interest total than the original debt itself. Person 2 decides to pay just a bit more than the minimum every month, say doubling it or adding a fixed extra amount on top. That single decision can cut years off the payoff time and save thousands of dollars in interest. Not because they earned more money, just because they changed how the payment was structured. This is the trap hiding inside. Your balance isn't shrinking. It's not usually that you're spending more than you think. It's that the interest is compounding faster than your minimum payment can outrun it. You're not standing still, you're on a treadmill that's tilted slightly uphill, and the minimum payment is just barely fast enough to keep you from sliding backward, not fast enough to move you forward. That's why so many people feel like they're doing everything right, and still not making progress. Structurally, the payment system is built around long repayment timelines because that's what generates revenue for card issuers. Roughly $170 billion a year in industry interest income comes from exactly this dynamic. What's being done and what's not? So what's the response to all this? On the regulatory side, there's been growing conversation in Washington about credit card interest rate caps, stronger disclosure rules, and oversight of buy now, pay later products, which have exploded in popularity, especially with younger consumers who are wary of traditional credit cards but end up in similar debt cycles anyway. It's worth noting, a lot of Gen Z and millennial spending is now happening through these installment-style services rather than traditional cards, and some analysts see this as simply moving the same problem into a less regulated corner of the financial system. On the bank side, hardship programs do exist. Again, most issuers offer temporary rate reductions, structured repayment plans, or short deferment options for people who are struggling. The problem, as we mentioned, is that participation is shockingly low. Most people either don't call and ask, or don't know the option exists at all. And broadly, there's a push toward automated savings tools, apps and bank features that quietly move small amounts of money into savings in the background, based on your spending patterns, as a way to build a cushion so people rely on credit cards less for genuine emergencies. It's a small structural fix for a big structural problem, but every bit of a buffer helps. What you can actually do. Let's bring this back to you. If you're carrying a balance right now, here's what actually moves the needle, based on everything we just covered. First, call your card issuer and ask, directly, about a hardship program or a lower rate. Costs you nothing to ask, and remember, only a small fraction of struggling borrowers even try this. You might be surprised what's on offer. Second, if you're paying the minimum, even an extra $20 or $50 a month can cut years off your payoff timeline. You don't need to double your payment to see a real difference. Third, look into a balance transfer to a 0% introductory card, or a fixed-rate personal loan if your credit allows it. Moving high-interest revolving debt into a lower, fixed-rate structure can be one of the single most effective moves available, because it stops the compounding while you pay it down. Fourth, build even a small emergency buffer, even a few $100s, because a huge share of new credit card debt isn't lifestyle spending. It's unplanned expenses with nowhere else to go. Breaking that cycle starts with having somewhere else for that money to come from. And finally, if you're managing multiple cards or a buy now, pay later plan, track it like you would any other loan. Know your due dates. Know your total exposure across every plan. It's easy for these balances to become invisible until they're not. Your credit card balance isn't stuck because you're bad at managing money. It's stuck because the system is built around 21% interest rates and minimum payments engineered to stretch repayment out for years, sometimes decades. Understanding that is the first step to actually beating it. If this helped make sense of what's happening with credit card debt in America right now, hit subscribe for more breakdowns like this, and let me know in the comments. Are you seeing your own balance move, or is it stuck too? I'll see you in the next one.